Welcome to CoreLogic's housing market update for May 2021, brought to you by onthehouse.com.au. Australian housing values lifted by 1.8% in April, according to CoreLogic's National Home Value Index, with the monthly pace of capital gains easing from a 32-year high in March. Although growth conditions have slowed, housing values are still rising at a rapid pace, up 6.8% over the past 3 months to be 10.2% higher than the COVID low back in September last year. The slowdown in housing value appreciation is unsurprising given the rapid rate of growth over the past 6 months, especially in the context of subdued wages growth. With housing prices rising faster than incomes, it's likely price-sensitive sectors of the market, such as first home buyers and lower-income households, are finding it harder to save for a deposit and fund their transactional costs. There's already some evidence fewer first-time buyers are in the market, with the Australian Bureau of Statistics reporting a 4.8% fall in the value of first home buyer home loans through February and March. Despite the slowdown, positive housing market conditions remain geographically broad-based, with every capital city and rest of state region continuing to record a lift in dwelling values over the month. Darwin and Sydney recorded the largest month-on-month rise in dwelling values, while Perth values recorded the lowest rate of growth amongst the capital cities at 0.8%. The 4 smallest capital cities recorded double-digit annual growth, reflecting a smaller COVID-related disruption and an earlier start to the growth phase last year. Melbourne is recording the lowest level of annual growth due to a larger downturn attributable to the extended lockdown period last year. The broad trend of houses outperforming the unit sector continued through April as higher density styles of housing experienced less demand amidst elevated supply across some inner city precincts. At the combined capital city level, house values have risen at double the pace of unit values over the first 4 months of the year. A preference shift away from higher density housing during a global pandemic is understandable. However, a rise in flexible working arrangements also seems to be supporting greater demand for houses around the outer fringes of the capital cities and regional locations. Relatively weak investor activity, compounded by a supply overhang in some high-rise precincts, is also dampening price growth in unit markets. In a further demonstration of the preference shift away from higher density styles of housing, the past 6 months has seen house sales tracking 19% above the decade average. Unit sales have also risen over the past 6 months, but are only 6% above the decade average. Strong selling conditions can also be seen in auction clearance rates, which have held in the upper 70% range throughout April, alongside the fall in median selling times and vendor discounting rates, which have now reduced to a record low median of just 26 days to sell a home, along with a median discounting rate of just 2.7% across the combined capitals. Perth housing values continue to rise in April, but the pace of gains slowed relative to earlier months. House values were up 0.9% in April, taking the annual growth rate to 6.9%, while unit values rose by 0.6% over the month to be 4.8% higher over the year. Selling conditions are extreme, with homes averaging just 17 days to sell. That's the fastest rate of sale across the capital cities and an equal record low with 2006, when selling conditions were just as tight as they are now. More homeowners are taking advantage of the strong selling conditions, with new listings added to the market in April tracking almost 25% higher than the 5-year average. Across the sub-regions of Perth, Mandurah is leading the pack, with values up 11% over the past 12 months. Overall, although conditions remain strong, there are mounting signs the housing market has moved through a peak rate of growth. Housing values over the past 6 months have been rising at an unsustainable rate and are now succumbing to a gradual slowdown in demand due to worsening affordability constraints, a rise in fresh inventory levels, higher levels of new detached housing supply, and less government stimulus. We are expecting housing values will continue to rise throughout 2021 and into 2022, albeit at a gradually slower pace. Demand should be supported by an expectation that mortgage rates will remain at their record lows for an extended period of time, as well as ongoing high levels of consumer confidence as the economy expands at a faster than average pace. The risks associated with the expiry of mortgage deferrals and less fiscal support have become far less significant. The proportion of home loans that remained on a deferral arrangement at the end of March was just 0.7% and comprised only 0.07% of bank mortgage books. Consequently, we're not expecting any material lift in distressed listings. For borrowers that remain in a distressed situation, the lift in housing values has reduced the risk of selling at a loss. In the most recent Financial Stability Review, the Reserve Bank estimates only 1.25% of Australian properties are in a situation where the loan amount exceeds the value of the home. The trend in labour markets will provide an important bearing for housing market outcomes. Labour markets have shown a V-shaped recovery through the COVID period to date. Although there may be some reversal in the trend due to the end of JobKeeper, this is likely to be temporary. Further tightening in labour markets post-JobKeeper should help to keep consumer sentiment high and provide a positive flow-on effect to housing demand. The possibility of tighter credit policies remains a key risk to the housing market outlook. The Reserve Bank and APRA have reiterated that they're watchful for any signs of slipping credit standards, but they've also noted there's been little evidence of a deterioration in lending standards to date. A rise in the proportion of riskier types of lending or higher risk loans could be met with a new round of credit policies. We know from earlier periods of macroprudential intervention that this would likely dampen market activity and the pace of capital gains. Clearly, there are a lot of factors at play and uncertainty related to COVID-19, both here in Australia and abroad, which will continue to exert some influence on economic activity. However, I think it's fair to say the risk factors have become substantially less concerning amidst a faster than expected economic recovery. In the meantime, if you'd like to stay up to date with all the housing market conditions, make sure you visit the research pages at www.corelogic.com.au.